towards the end of this webinar. Today's session promises to be truly engaging and insightful. The welcome address will be delivered by the CEO, Nigerian Exchange Limited, Mr. Temi Popola. His welcome remarks will be followed by a presentation from Mr. Taiwo Oyedele, Fiscal Policy Partner and African Tax Leader, PwC. Please use the Q&A function to ask your questions, and they will be addressed during their dedicated Q&A session. I would now like to call on Mr. Temi Popola, CEO, Nigerian Exchange Limited, to give his opening remarks.
Anu, thank you very much. And distinguished ladies and gentlemen, good morning. On behalf of the Board of Directors, the management and the staff of Nigerian Exchange Limited, I am extremely pleased and delighted to welcome you to our Finance Act webinar. This webinar is a part of the Exchange's capacity building efforts to arm our various stakeholders with all of the relevant knowledge that they need whilst operating in the capital markets. I want to start by appreciating and thanking our partners for this event, the Association of Securities Dealing Houses, ASHAN, the Chartered Institute of Stockbrokers, CIS, and of course, PricewaterhouseCoopers for their contribution towards the organization of this webinar. This webinar is set up to garner expert insight on how the changes in the Finance Act 2021 will impact the Nigerian capital markets. The Finance Act 2021 amends some key provisions of the laws such as the Capital Gains Tax, the Companies Income Tax Act, the Federal Inland Revenue Service Establishment Act, the Personal Income Tax Act, Stamp Duties Act, the Tertiary Education Trust Fund Establishment Act, and the Value Added Tax Act, amongst many others. These amendments were made as part of the expansion of the federal government's fiscal policy and harmonization with international best practice for the taxation of new areas of the modern global economy. These changes impact not just the capital markets, but commercial companies such as telecoms, ICT, oil and gas, amongst many others. Against this backdrop, today's webinar aims to sensitize stakeholders and intermediaries in the Nigerian capital markets under a common forum to understand key provisions in the Finance Act 2021. The amendments were primarily aimed at addressing ambiguities and providing clarity to certain provisions in the existing Act as applicable to economic activities in Nigeria. At NGX, we recognize the need to organize events like this to guide stakeholders, to build capacity, and to collaborate with specialists in educating market participants and the general public at large. The Exchange continues to deploy other initiatives, such as new products, initiatives aimed at deepening the markets, at diversifying our products, and enhancing liquidity. On the Act, I need to also stress that we are very much aware, I'm sure most market participants are, that the Finance Act for 2022 is already currently in progress as per usual protocols and procedures by the appropriate ministry. Typically, the Exchange will, in January of the next year, discuss this Act as well. And so just thought to highlight this. This event today is specifically on the 2021 Finance Act, particularly to address parts of this Act that we find critical to our stakeholders. I hope that you will gain new insights on how the Finance Act provisions will impact the capital market and provide clarity on the amendments that have been recently introduced. Let me conclude by saying that we hope that this will be a truly interactive session. We expect many questions, many comments for a fruitful and rewarding session together. I thank you very much for listening. Thank you.
All right, thank you very much, Mr. Popola, for your insightful remarks. Before I proceed, I'd also like to remind us to please type in our questions in the Q&A box, and we'll be responding to them during the Q&A session. We'll now proceed to the webinar presentation to be facilitated by Mr. Taiwo Oyedele, Fiscal Policy Partner and African Tax Leader, PwC. Mr. Oyedele, you have the floor now. Thank you.
Thank you. Thank you very much, Anu, and thank you to the NGS and particularly Mr. Temi Popola and the other stakeholders for inviting me. I have only 25 minutes, so I'll go straight into it. So the focus of my presentation is on the Finance Act and also related fiscal policy changes and how those are impacting the capital markets. So the agenda I have is to quickly, I always do this. I thought it's always very useful to provide the economic context to this kind of conversation, and then look at the state of the Nigerian capital markets. And then we focus on those changes and how they impact on the various stakeholders. And then I'll share my closing thoughts and what I think we should do in terms of the next steps. So I'm just mindful of, trying to see my time. Okay. So we know that Nigeria is not where it needs to be. And I thought that this graph, this chart that you see to the right of the screen by StatiSense is instructive. Sometimes whether one administration is able to grow the economy or not, it's not a matter of politics. It's not about supporting one against the other. Sometimes it's about the issues that we have to deal with. Sometimes it's driven by the price of crude oil. As we now know it, for Nigeria, production is even more important than the price. But whatever it is, this is how the picture looks like. And then, we're having to deal with insecurity, dealing with rising inflation, we're dealing with unemployment that is quite high, we're dealing with growing poverty, we're dealing with high public debt. Some numbers have it at over 60 trillion a few days ago by just adding the ways and means, which was already crossing 20 trillion naira. Then you have declining investments, whether it's foreign portfolio investments, whether it's foreign direct investments, even domestic investments is not growing because for anybody to be able to invest, you need finance. Therefore, there's also low gross capital formation. For those that are doing business, they're just trying to stay afloat and sustain the capacity that they have. Not many people are trying to, expand their capacity. It's the pre-election year. And when I look at this data, I said, well, we need to do a lot of work in Nigeria because 38% of the adult population, that's about 42 million people, are illiterate. So why that's important is these are the guys who normally vote. Come rain, come shine, they'll go and queue for 10 hours. They don't care. They'll be there, they'll vote. And most times they're voting not because they understand what the issues are and what the implications are, but sometimes based on sentiment. But it is what it is. We've seen industrial actions. Universities are back. We don't know whether they're really back or they're just doing that to comply with a court order so that they can get another judgment in their favor and continue with the strike. There's the great resignation and migration about people leaving Nigeria to other places worldwide. People are resigning from employment, and that's having impact on businesses, including listed entities. And the point I also want to highlight here is what we have seen. It's not just that people are migrating, we also have corporate migration. So that is a company deciding to leave one location to go to another, sometimes in terms of formalities and where they are headquartered. And we've seen some of our unicorns. So if you Google today and you Google Andela, you're going to see that it says that Andela is a New York headquartered company, right? Geopolitics is complicating our lives from Russia and Ukraine, sometimes to other issues, including the UK, the EU, the rest of the world. But Nigeria remains the largest country in Africa, so still something to share about. And we're still growing, even though slower than we would like it to be. So, I came up with these big 5 factors recently when I was speaking to some CEOs. I said, well, these are the things, in my view, from a fiscal policy and monetary policy point of view, that are shaping the Nigerian economy, from debt to taxes to foreign exchange management to rising interest rates and then subsidies, the elephants in the room. So all of these are having an impact one way or the other. So if we look at the state of the Nigerian capital market, this was a slide I put together a few months ago. I thought there was no point trying to update it because the storyline is still all the same. And what this shows is just to let us know that while we have made some progress with the Nigerian capital market, we still have a big room for improvement. There's still a long way to go. We're just barely scratching the surface if we think about where we should be at this time. And you can just see the comparison there. You see the market capitalization. As at the time I did this analysis, Nigeria was $57 billion. As of today, if you use the exchange rate, because you know, the exchange rate is depreciating even faster than the growth in the capital market, it's actually less than 57 billion. Maybe it's about 54, 55. But just compare that to the next country on that list, South Africa, which is the second largest economy in Africa. It's over $1 trillion. So we have a long way to go. And the reason why I thought it's important to emphasize this, particularly for policymakers, is the analogy I always use about, are we taxing seed or are we taxing fruits? So we may be tempted to think that there's already fruit when indeed we are still planting. My honest view is that looking at these numbers alone, it's so obvious and clear to me that the capital market is still at the seed stage where we need to plant, we need to water it, we need to nurture it and let it grow. And of course, when it grows, we all benefit, including government. We make a lot of money from that. So whether you're talking about the size, the depth, the efficiency, you know, all of that require a lot of focus. We have other data there in terms of contribution to GDP, in terms of the percentage of the population investing in the capital market, how vibrant it is, and so on and so forth. You know, what do we want it to be actually? So having said that, the Nigerian capital market that we want, in my view, is the one that, you know, help us to grow. Economic recovery and development require investment, and you cannot develop without funding, and you cannot fund without a robust capital market. That's so obvious. Requires no compelling analysis for anybody to understand that. And then you also find that in many cases, you're able to promote wealth and prosperity using the capital market. There was a time last year, I think it was last year, when Elon Musk tweeted that he was going to pay about $11 billion in personal income tax. So I just couldn't resist the temptation of converting it to Naira and then comparing it with the personal income tax revenue we've collected in Nigeria. And I discovered that the personal income tax collected in Nigeria in the past 4 years, all 36 states, Federal Capital Territory, was less than what Elon Musk alone paid. So the point is, if we allow prosperity and people make plenty of wealth, then it will be so easy for government to rake in revenue from taxes. So we also find unicorns. Some of them, once they get to that point, they go and list elsewhere, outside Nigeria. This capital market will help us with financing economic development, efficient resource allocation, channel capital to critical sectors. It may be electricity and power today. It may be infrastructure tomorrow to do with maybe rail, ports, whatever it is. The capital market is so efficient in making that allocation, far better than, say, government, for example. It will help us with stronger and stable Naira. So if people all over the world are willing to invest in Nigeria, invest in the capital markets, even though we prefer FDI to FPI, but we actually don't mind whatever we can get at this time, then you have liquidity of dollar, and therefore your Naira is more stable. And in fact, the irony is, the more stable your currency is, the more investment you attract. And therefore, by contrast, the more unstable and volatile your currency is, the less investment you're able to attract. There's wealth creation, I said that already, promoting financial inclusion, financing ESG and SDG. Nigeria has made a lot of commitments, and also to position Nigeria for global and regional relevance, starting with the African Continental Free Trade Area. Overall, Nigeria needs a capital market that is able to finance growth and sustainable development. So now let's move on to the main thrust of this presentation. So what are those key changes that we have seen? So I've tried to put them under 4 broad buckets. One is to start with what I consider to be the good news. So we don't leave this session thinking that everything has been bad. That's not the issue. That's not the focus. The issue is for us to speak about what we are dealing with objectively as key stakeholders, not only in the capital market, but in the corporate Nigeria. Favorable tax reforms have happened, maybe not all in 2021 Finance Act. I know you wanted me to focus on 2021 Finance Act. I couldn't find a lot of positives there, so I decided to go back a little bit to Finance Act 2020 and 2019. But overall, we have seen reforms relating to the real estate investment trust. Many of us advocated for many years saying that you just can't, build the real estate investment trust sector with the kind of tax framework that we had in place. Because what that was doing, it was cascading the impact of taxes. 30% is already high enough. To have to pay that one or twice more, it's just going to be impossible for any business to thrive. So that tax framework has been fixed. Even though we still haven't seen the growth the way we want it, but at least that's one problem out of the way. And then we have enabling tax rules for security lending. So before those reforms were carried out, also if you embark on anything to do with security lending, you ended up paying taxes multiple times, particularly withholding tax. And more recently in the Finance Act 2021, there was a provision to say that if you suffer withholding tax on unit trust, it will be your final tax. You won't have to pay any additional tax. And in fact, if the unit trust had already paid taxes on the source of the income, such as dividend, you won't have to pay any further taxes. So those are positive. The not so positive, that's the way I'll put them. The first one is we have expiration of a number of tax waivers. One is we have exemption of corporate income tax on bonds. And these bonds were government bonds, federal and state, and they were also local government bonds, but more importantly, they were also corporate bonds. So which meant that if an entity listed on the Nigerian capital market were to issue a bond, there will be no tax on the interest. And what that meant was the cost of raising finance was affordable to the businesses. The returns on the investment was competitive and attractive to the investors, and that created the liquidity for businesses to be able to do their business, which we all know have ripple and multiple and multiplier effects on the economy, from creating employment to increasing the GDP and so on and so forth. So this order was issued in 2012. And that should be by the Jonathan administration, I believe. And then it had a tenure of 10 years. Many of us were singing the song of let's expand it, particularly because of, where we found ourselves since COVID-19. That was not very successful, so government allowed the incentive to lapse on the basis that their policy direction is that if you have an incentive, you should have a sunset clause, and you should allow it to expire and see the impact. I said, okay, maybe fair enough. Now that it has expired and getting to about 1 year, because it expired on the 1st of January this year, which means from the 2nd of January 2022, the tax exemption was no longer applicable on corporate bonds and state government bonds. Interestingly, the federal government will continue to enjoy exemption on their own bond because they have another provision in what we call the Local Loans Act that continues to give exemption to government. On one hand also, even though I don't want to play into that sentiment, it does not provide a level playing field. That one level of government can enjoy exemption, other level of government cannot enjoy it, and then the private sector cannot enjoy it. When we were in school in those days, we were told that government bonds were risk-free on the basis that if anything happens, government can print the money and give it back to you. So already you have an instrument that is risk-free, and then it is commanding higher returns. So there is no, sensible investor that will ignore all of that and say that I really love private sector, and you go and invest it. Higher risk, lower effective returns, it's just not going to work. We also have the VAT exemption that was applicable before on capital market transactions, including commission, that lapsed even earlier before the CIT exemption that came into expiration this year. The other categories that I want to talk about, the next one is new taxes. Unfortunately, we've had imposition of what I'll consider a new tax, as well as even some increases in existing taxes. So the major one here is the imposition of capital gains tax on the sale of shares. So for many years, if you sold shares in the capital market, your capital gains were exempted from taxes. You didn't have to pay tax. So that was amended in the 2021 Finance Act, such that now, if you sell shares in the capital market, you pay capital gains tax at 10%, except number one, if the amount is less than 100 million within a period of 12 consecutive months. So which means, you sell today, you may not sell for the next 4 months, you sell again, we keep adding it up for the next 12 months. Once 12 months passes, you drop off the first sale. You keep doing that 12 months cumulatively. If it crosses 100 million, you have to pay the tax. If it's less than 100 million, you won't have to pay the tax. Now, if it crosses 100 million, there's another condition that can help you, and that's to reinvest the proceeds in the Nigerian capital markets. It could be in the same company where you sold. It could be another company. It doesn't matter. It has to be just listed on the stock exchange. And then the other condition is if you are doing this buying and selling of shares in a security lending transaction, then it's exempted from tax. Where you have, proceeds exceeding 100 million and you partly reinvest some and you did not reinvest some, that reinvestment has to happen within 1 year of assessment, the same year of assessment. Excuse me, a year of assessment is really a calendar year. So which means if you sold 120 million worth of shares in terms of proceeds, but you only reinvested, say, 70 million, then on the amount that was not reinvested, you would then have to pay the tax. In this case, that would be 50 million. I think beyond the fact that this tax was introduced, regardless of the fact that we had a lot of advocacy against it, was concerning for me, because when we did the analysis, it wasn't going to bring a lot of money for government. The amount that you're going to get was going to be insignificant. In our, and Mr. Pupola mentioned this, in his comment, we started the meeting for the Fiscal Policy Committee actually yesterday to look at the finance bill for 2022, which will take effect from next year, 2023. And in our group, someone had shared, the account of NAPIMS. So the latest account of NAPIMS had about 20-something billion as PR for 2020. And by 2021, it had increased to 89 billion. So I said the increase, that amount alone that is being spent on PR by NAPIMS is more than 3 different taxes combined, of course, including even this one. You just imagine that. So we could have easily repealed or suspended 3 taxes and we'll still be fine if we got NAPIMS not to spend as much on PR. So the signaling is not very positive. I remember for many years, foreign investors will send us requests at PwC to say advise us about investing in the capital market. And we just gladly say that there are exemptions in terms of capital gains. Now, we can't say that anymore. Once you say there is a tax, notwithstanding all the conditions for exemption that you list. So the person investing from the UK, from the US, they just see, what they just said is there's capital gains tax. They're really not much interested in those thresholds and exemption. And by the way, their investment is likely to cross those thresholds. Now, the other things affecting the capital market, including taxes that directly affect companies that are listed, such as the increase in tertiary education tax to 2.5%. It was 2% before. I did some analysis recently, just looking at how much companies have paid in tertiary education tax over the past 10 years. And of course, you know that majority of companies that are paying this taxis are listed on the stock market. And I got exactly 2 trillion, just a little over 2 trillion naira over the past 10 years. And I said to myself, well, yeah, there's a lot government could have done to improve the education sector, but who is explaining to us how this 2 trillion has been spent over the past 10 years? How come we're not really seeing the impact on that sector? Yet we continue to pay. And that's one thing with tax laws, you know, so even though it's meant to be a social contract, but even when you're not seeing the result, you are still under obligation to pay, otherwise you have to deal with the penalties and the consequences. We also have a new law that was introduced, NASENI, that's the National Science Engineering Institute, you know, and they said we should make some contributions to help fund science and engineering. I said, well, we've been here before. We had a law was introduced for us to fund technology under the law around, you know, developing the technology sector. And then we haven't seen the development. A lot of the development we've seen around have been private sector funded. It's been, you know, young people, small businesses, large businesses making those investments. Not really a lot coming from the government side. And there's also the minimum tax that companies have to pay. And the logic behind this minimum tax is really don't trust companies. Sometimes they don't want to declare profit, so they don't have to pay tax. So we impose a minimum tax on them. And I say, well, this is completely not true for listed entities. The much I know about listed entities is they like to declare profit because that's good for their share prices. So if anything at all, the risk you find with listed entities is that they might overstate their profit, not to understate it. So, and on that basis, my argument is you shouldn't have to apply the minimum tax to listed entities. We also have police levy was introduced for companies operating in Nigeria to fund the Nigerian police. We've also seen more recently increases in excise duties, including imposition of excise on some products such as non-alcoholic beverages, and some of those companies are listed on the capital market. And even as we speak now, government is planning to further increase those rates, which I have to be honest with you, I don't understand where the thinking is coming from, given that what we see across the world is governments are either reducing taxes or freezing them because the economies of the world are in difficult shape, and also because of the cost of living crisis, of which Nigeria is not exempted. Our inflation rate has been rising and continues to rise. Now we have the flood. We don't know what's going to happen to food inflation. Now we're hoping that as we approach the harvest season, inflation will start to go down. But with flood now all over the place, that hope it seems to be disappearing. And then to still continue to impose higher taxes, it's going to be a difficult one for me to reconcile. So these are the summary of the tax changes and fiscal policies affecting the capital markets. I'll try and wrap up now. I think I only just have maybe 2 or 3 minutes. So if you think about brokers and dealers, what would this mean for you? Your tax costs will go up, your tax risk will go up because you may make a mistake, you may interpret this wrongly, you may file the returns at the wrong time, and that becomes a risk for you. Compliance burden, even when you get it right, you still have to spend money to comply. And then there are filing and reporting requirements. For issuers, you have big impacts, higher costs of raising funds. In fact, my analysis shows that if you were raising 1 billion naira in corporate bond before and after, the cost in the returns that the investors will receive, the cost is at least 40% higher. So from 0%, you are hitting about 40% cost going to government in taxes. So that's very high. That's very high, especially if you're a corporate entity where you have to pay CIT is 30%, education tax is 2.5%. Then there's withholding tax of 10% on the balance. That takes it a little bit over 40%. However, if the investors are individuals, so individuals will still continue to enjoy a lot of exemptions, so the impact on them will be minimal. This makes us uncompetitive both locally and also internationally for international investors, because I'll say instead of doing a corporate bond of a Nigerian entity, why don't I do government bond? Why don't I look for investments in another market? There's also the elevated risk of crowding out, because you make government bond, federal government bond, more attractive than corporate. It's also the time that going to the bank is almost a no-go area to go and raise capital. For investment advisors, they need in-depth knowledge so they can advise wisely and correctly. They also have the compliance burden, they have the risk and exposure, and then there'll be less business opportunities, because what we've seen now is corporate bond activities have declined in the capital market. That's less business opportunities. For regulators, compliance enforcement and monitoring will be part of what they have to do. And government themselves, they need to then monitor the revenue they are making from this. And then for SEC and NGS, this can have an implication for their own revenues, because if the activities are down, the charges and the fees going to these regulators would also reduce. For investors, high cost of tax and burden of compliance, uncompetitive after-tax returns, and in some cases, especially for capital gains tax, we think that investors may actually be taxed despite making real losses. So on paper, it looks like they have made a gain when they sell, but compared to the real value of money, they have actually made a loss. On top of making a loss, they are now being asked to pay a tax. That just multiplies the pain. And then there's a lot of tax uncertainties. So all stakeholders must seek to understand the various changes and collaborate to drive positive reforms. So my closing thoughts are, we need to work together, carry out an impact assessment on these recent tax and fiscal policy changes on the capital market. I have 25 minutes to make this presentation. If you allow me a whole day, I'll easily spend 8 hours telling you about these issues. Then seek clarification and guidance from the authorities, including FRS, on the gray areas. For example, in the Capital Gains Tax Act, it says that if you have capital gains, you must file returns by 30th of June and 31st of December. So if you sold in February, you file the returns and pay by 30th of June. If you sold from 1st of July, you file it by 31st of December. Whereas this tax imposing CGT on shares in the capital market says that you file your returns on an annual basis. So the question is, how do I reconcile this? So if I sell in April, I'm still waiting for my 12 months to see whether there will be a trigger for me to pay the tax. But the one section of the law says I must file returns and pay in June. Another one says it's annual. If I don't clarify that, you can easily find yourself on the wrong side of the interpretation of the taxman, imposing penalty and interest on you, and then you end up in court spending 5 years, wasting time and resources. So the idea is, it's better to clarify this on time and be on the same page. Then situate your conversation about the capital market within the context of the broader Nigerian economic aspiration. So it shouldn't be that we're trying to advocate to protect the market players, which is important, but I find that it's easier to have a meaningful conversation with policymakers when you let them see there's something in it for them. So I'll say, based on your own economic plan, this is what you want to do for Nigeria. You want to create employment. You want to grow the GDP. You want to lift people out of poverty. And I see the capital market playing the most significant role in that. So why don't we work together, right? Then proactively engage government to drive this hard reform. I'm hoping that we have some submissions from this group going to the Fiscal Policy Committee. I know SEC is a member, so we can deliberate that, because yesterday, some of us raised the point around this expiration of the bond, and the response from government was still, well, we needed to allow it to expire, right? So now that it has expired, we need to push. Prioritize removal of tax disincentives, because government will say we don't have money to give you waivers, we're struggling with tax to GDP ratio. We say, okay, that's fine, but there are a lot of things we can do that will not cost you money, including, for example, some reforms around impediments. And then the ones that, government will make only 20 billion in a whole year and give everybody a headache, really, to me, it's almost nothing to government. So need for predictability, consistency, and policy coordination is important, from investment policies to business regulation to fiscal and monetary policy. So on monetary policy side, If you make it difficult for me to take my money out, legitimate money that I brought in, if you make it difficult for me to take it out, then I won't bring new ones in, right? So it's just logical. If you allow free access to money to the extent that they are legitimate transactions driven by market forces, then more money will come in. But if you make it difficult for them to go, then they will stop coming. Then finally, monitoring and feedback. We need to keep, policy design, proposed changes, and implementation under constant review to avoid surprises. So this is what I have, and hopefully I think I've kept to the time allocated to me. Abraham Lincoln said the best way to predict the future is to create it. So thank you very much.
All right, thank you so much, Mr. Is fiscal leader, PwC, just took us through the implication of the 2021 Finance Act on the capital market. Thank you very much for this insightful session. Our very first question is coming from Mr. Tepobola. I'll be bringing back Mr. Tepobola to take the very first question.
Thank you very much. Mr. Oyedele, I should start by thanking you, for a few reasons. Some people have described you as one of the biggest advocates of capital markets on the private sector side. You're in many of these meetings and that fiscal policy committee. And we do know that you have a very good holistic understanding and you do push the capital market agenda to the extent possible. So we're very grateful for that. I think also, of course, a lot of the education that you continue to do for us, both publicly like this and a lot of the time also behind the scenes, extremely well appreciated. Now, my question really is, you have done a very good job at foreseeing what are the challenges with some of these policies. I remember maybe just about this time, 8 months ago or so, when this act was announced, and one of the things that you had said publicly was the potential impact of some of these things on liquidity. So this very good example that you've given, if I'm a fund manager today or a broker, and there's this potential pitfall of when is 100 million naira, when is July, when is December, what is a capital market transaction, for example. And you had said at the time that it has the likelihood of, just impacting liquidity negatively. And particularly this point that you repeated this morning, that when you also look at the potential returns to the government, vis-a-vis the damage that it could do, I use that word damage lightly, to the capital markets, or let me say unintended consequences. You didn't think it was the right thing. Now, if we come back now 9 months thereafter, we have seen a dramatic decline, in the amount of liquidity in the capital markets. It's almost very, very prescient of sorts, the comments that you had made. Of course, when you layer that with rising interest rates, it's almost a double whammy. So this is one example, and I'm giving this background to lead to really the comment or the question I have, where, just coming into this, we saw the potential bottleneck, and this is a real practical implication now. Liquidity is down about 30-40% year on year. If you look at the corporate bonds also, this was another point that you had made at the time months ago about the potential impact on discouraging issuers in the bond markets. Just the cost of funding is just much higher to you, period, as a corporate company. And if you also come back to another big trend, one trend that we're seeing today is private markets over public markets. Most people, most transactions just prefer to go private today. So again, another double whammy that when we look in that bond market, you've seen a material decline. So my question to you is really more to start with, if you were to advise market operators like ourselves, vis-a-vis the broader context, which I think we all understand, the fiscal situation in Nigeria is challenging. At maybe 5% tax receipts to GDP, we rank very low globally. So we understand that. You made that point about taxing seed rather than taxing real fruits. But for us who operate capital markets, who also try to advocate for our intermediaries, for our business, how else do you think we should be thinking about these things that are material in nature to the very structure and existence of the Nigerian capital markets? Thank you.
Thank you very, 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 very fundamental question you've asked now, because, like we all said, there's no point lamenting about these issues and then move on to the next lamentation. It's about what can we really do about it. I think what I would recommend at this point is let's put data together, because I find that, so in many countries, compared to Nigeria, you find governments on their own are very, very, and I'll use this word advisedly, respectful of data. So even government themselves will be interested in impact assessment. Unfortunately, that's not something we're very good at in Nigeria. So which means it's now the responsibility falls on our shoulder to then offer that to government. So I'll say, whatever you can put together from all the operators and also the NGS itself, to say, government, now we've done this for 9, 10 months. This is what we're seeing. Even if you didn't believe us before, the data is there, and data, like they say, don't lie. And then be able to link that back to the objective of why they introduced those taxes, to say, well, even the reason why I introduced the taxes now, because if you allow me as the capital market to finance activities, when businesses are actively engaged, they make more profits, they pay you more CIT, they make more sales, they pay you more VAT. So you may easily have gained 10 billion naira in 9 months. That's my rough estimate. I don't have any data, and I won't be surprised that when you do the analysis, it won't be far from this number I just called. But you have lost 200 billion easily. So what that means is even your own objective, this is a contradiction, is counterproductive. And lay that on the table to say, we do know and we recognize that you need more money, but we just believe, based on available data, that this is not the way to find it. Let's think together about where else the money can come from. That will not be, pounds, penny wise and pounds foolish, like they call it. So that's, and I'm willing, as always, I'm willing to support you in that process if it's something that this group wants to take up.
Thank you very much.
All right, thank you very much, Mr. Taiwo. I would now delve into the questions that we have received from our participants today. The very first question says, what happens to a corporate bond issued in 2021 with 5-year maturity? Does it mean that VAT will apply from 2nd January 2022?
Excellent question. So these were some of the things we had to analyze immediately this thing was expiring. So the VAT is not the main problem. VAT is a very small tax incentive because it's not applicable on the principal investment itself. So if you invest ₦1 million in the capital market, so that ₦1 million is not liable to VAT. But then the commission on it, and the commission is a small percentage, and then VAT is also a small percentage of that amount. I would prefer that we don't have the VAT, but to be honest, I wouldn't worry too much about VAT. I think the last time I analyzed it, it was coming to around 1,000 naira for a 1 million naira investment. But the big one is the, on the bond, is the expiration of the waiver of taxes, including withholding tax and corporate income tax. So if you had a bond that you had issued in 2021, just before the expiration, unfortunately, tax exemption accrues based on when the interest was earned, not when the contract was entered into. I use this one now as a contract. So it means that any interest that you pay relating to when the bond was issued up until 1st of January 2022 will be tax-free. Any interest that accrues, not even the one that you pay, is the one that accrues from 2nd of January this year going forward. You have to pay the tax on it, unfortunately.
All right, thank you very much, sir. So the next question is from Suleiman Gaba, and it says, will the introduction of digital assets and virtual assets service providers by the SEC contribute to capital formation and market capitalization? Is digital asset taxation covered in the Finance Act 2021 or the Finance Bill 2022?
Yeah, interesting question. The answer is yes. Any new classes or existing classes that you can allow to scale is good for the market, and that's where the rest of the world is going. We shouldn't, be found wanting. Yes. So the answer is those new classes, including digital assets, would improve activities and help mobilize even more resources. In fact, some of these asset classes can help you mobilize resources in foreign currency, which is something we're struggling with at the moment. But in terms of the taxes, and that's why I said this is interesting, because it's an area where policymakers don't fully understand. I have to be honest with you. They don't understand it, whether it's in the US, whether it's in the UK, and even more so in Africa, and also Nigeria. So we haven't seen a lot of clarity as to how the taxes should be treated. We have seen SEC taking a position about the form of investment that it will be classified as. And then we've seen the federal government, particularly the FRS, sometimes make a different interpretation, because the debate globally is whether this is a capital, gain issue, is it a company income tax gain issue, or is it not even a gain that is liable to tax, right? Can I just take it like it's money, money itself? So that conversation, I would say, is ongoing. Nigeria does not have a landing. My personal view on it is that, whenever you have any new area, don't start with taxes. Start with how can we support them? Just imagine that philosophy. You see any new area that is growing, and you say, how can we help them? So help first. And then when it gets to maturity and people are, cleaning out, you can say, okay, by the way, government too has a stake. Especially because not only the law says we have a stake, it's because we have invested and provided the environment for you to grow. So that's the way I'll call it. I'll describe it at the moment, nothing significant. Some of the state internal revenue services and the FRS says if you make a gain from those digital assets, you should declare it. And then, of course, they're going to tax you on it. But the legal framework hasn't been fine-tuned.
All right, thank you so much for that response. I'll move over to the next one. And this from an anonymous attendee says, sir, you didn't mention the unclaimed dividend fund. What about it? Dividends already have withholding tax. Will unclaimed dividend be taxed too?
Yeah, so the unclaimed dividends fund was introduced in the 2020 Finance Act, I believe. I know it was in 2021. And of course, we all understand what government is trying to do is to say you have unclaimed dividend, they're just lying in different pockets or people benefiting from them. Why don't you give it to government? So that when people show up and they want to claim those dividends, government will give it to them. Maybe even with some, right? But the reality is that we know that government know, all of us know as well, that it's also a way of just taking those assets, because they know that many of those people either are unable to claim, sometimes for legal impediments, because the process for claiming dividend if someone was deceased is so ridiculously unbelievable that the amount that you want to claim has to be maybe millions of naira for you to even want to embark on that journey. So if the amount is 20,000 naira, who wants to go through that process? So I thought that government should have addressed those impediments first. Can we simplify the process for people to claim it before you think about taking over those assets? But then in terms of the question itself, yes, it is true. Withholding tax would have been deducted on the dividend before it was paid to the shareholder, and then wasn't claimed, and therefore is an unclaimed dividend. So when it goes to government, there'll be no further tax on it. So when the shareholder shows up and they want to collect their money, they'll collect the full amount that they should have collected at the time the dividend was paid by the company.
Okay, all right, thank you very much. This one is from Olufemi Oluwole, and it says, please, what is the tax implication for litigation proceeds, cost arising from legal matters in the capital market transaction?
Yeah, so we have a provision in the law to deal with this. So if you have a litigation and you're trying to make a claim, it will now be a function of what was it that you were trying to claim for, right? So anything that is in form of a compensation, you will not pay tax on it unless that compensation is more than what you lost. So for example, you lost something worth 1 million and the compensation is 1.5 million. Government will say, by the way, you recovered your loss and you have an extra. So can you pay tax on the extra? Of course, if the compensation is less than what you lost, government says, okay, yeah, we're sorry. So unless, of course, it's really what you do on a regular basis, that's when you can take a deduction for it. For personal income tax, we also have a provision for in the tax law. In some cases, the compensation could be a compensation for something that is not quantifiable. I don't know whether that happens in the capital market, but if it costs me, for example, an emotional pain or distress because of the shares I've invested, I needed the money to pay for my school fees, you didn't allow me to sell it on time, I lost the opportunity to go to a school abroad, something like that. So, and I'm claiming for that, non-financial damage. So when you get that, you have to pay tax on it because the tax authority don't understand how to put a cost to what you have suffered. So that's really how it works. But I would say ultimately, it will be a function of what is it that forms the basis for that claim in the first place.
Okay. All right. Thank you. Thank you so much. This one says, since I started working in the capital market, I've been hearing that we have to engage government on favorable reforms, but it seems as if this is not happening. In your opinion, why do you think we have not gotten the desired attention?
Yeah, I know, because I get involved with many of the stakeholders as well. I will easily give a lot of credit to the NGX as well as SEC. So I do know there's some engagement. So I'm not saying that there's no engagement. I'm saying there has to be more. And particularly because in a way, SEC is seen to be part of government. So when SEC is saying something, maybe it carries less weight than when it's coming from the private sector. So what I really want us to do is to have a bigger platform, involve more stakeholders, and present evidence, data-driven, objective, compelling analysis. Some of it is you have this direct engagement with policymakers, but there's really also nothing wrong in putting it out there in the public space. You can call a press briefing, so even for an event like this, we can prepare a press briefing, and after this, you call the press and share it with them. And then tomorrow you see it in 5 or 6 newspapers. Because those things have a way, politicians, even when they don't like what you're saying, if they think that the public is interested, they take interest because they know it's in their own selfish interest as well to go with the public. So I think what we need to do is let's find a platform that would, bring everybody on board, the key stakeholders, and then find, I don't want us to always be reactive. It's better always to be proactive. So find a way to engage with government at least once a year. And I'll say before the finance bills. So if we target a new report, and it could just be, a pulse of the capital market. It could be a state of affairs assessment. And you publish it around, July, August. You make a lot of noise to the press, sometimes just to make them understand. And then in the build-up to that, you have submissions that will go to government. So they know every time, even when there's nothing. You're the one that goes first. Imagine if you go first to say this is what we want, government will now be on the defensive. They won't be the one pushing taxes to you, and then you're trying to react. So that's what I would recommend. Let's create a platform, and also maybe work with the other organized private sector groups. NESD is a very formidable one. There's the LCCI. There's also NECA trying to do a lot now. So we can also leverage on those other platforms.
All right, thank you. Thank you so much. This is from Dr. Amos Adesina, and it says, please, Mr. Taiwo, can you relate all these taxes, both new and old, to the ease of doing business in Nigeria?
Yes, they make ease of doing business complicated. So in the ranking, interestingly, we're involved with the World Bank for many years until they stopped the ease of doing business last year. So I know how the data is computed, and the reality is the more taxes you have, the lower your ranking. So if we're going to do another ranking for this year, Nigeria would have become more difficult to do business than it was the previous year. And this is one of the things we're saying to government.
Okay, all right. And this is from Andy Tisako. It says, striking the right balance between the necessity of tax as a veritable tool in financing government's pivotal needs and the burden thereof on the citizenry remains an Herculean task. I'm worried particularly with the inconsistency in tax policies being reduced to almost a tactical issue rather than a strategic one. What could be your candid advice in addressing issues like this?
Yes, I think the first one would be coordination. So what I've seen is that when you don't have that central point for tax reform, fiscal policy reform, everybody comes. Some people go to business school that they didn't fully understand what they were taught there. Some of these are even international schools, Ivy League. You come with this half idea that has worked somewhere in Europe, you sell it to someone in government that is close to you, and the next day it becomes a government policy. And that's a frustration for me personally, being very much involved in these conversations from time to time. So when you have a central point, and then you develop, that's why we developed a national tax policy, and I was privileged to work significantly on that policy so that everything is aligned. So if there was someone who had been the anchor for fiscal policy and driving everything, they would have known that the national tax policy is very clear about how do you impose taxes. It says let's have fewer taxes, not 66 of them. It says they should be broad-based, right? It says that you have threshold to protect the vulnerable. When I was pushing for exemption of minimum wage from personal income tax, it was like rocket science. I thought it should be so easy for everybody to understand that you can't be taxing someone who is earning 30,000. In fact, my analysis now shows that if you ask anyone who earns less than 75,000 naira a month to pay any personal income tax, you are taxing poverty. And when you're taxing poverty, what you do, you are fueling social crisis. Because when people can't feed themselves and they have no hope when the next meal is coming from, they cannot be rational. If they don't take to violence, you're lucky. They're going to be misbehaving socially. And that becomes a bigger problem for government to even deal with. So this understanding of how does tax and fiscal policy fit in within the broader economic context and your peculiar circumstances is missing in my view. And that's why you see people pulling in different directions, and then we all suffer for it. So the way to do it is just to have a coordinating point. I'm hoping that the next administration we have like a coordinating minister for the economy, or allow the vice president to do that, because constitutionally he's meant to lead the economy issue. So anybody that comes up with one brilliant idea of ozone layer tax should go and convince those people who have better understanding and history of why these things can work or how they can work. And then we take it forward from there, so that is really my own recommendation. I think the knowledge is there, it's just not being harnessed and coordinated properly.
All right, thank you. Thank you again for this response. This says the issue of taxing the seed instead of the fruit is profound and fundamental. Can the government and the tax laws incorporate the effects of inflation and exchange rate changes in the tax computation? If it is possible, how should it be advocated?
Yes, indeed. Like the simple example of you invested 1 million naira 10 years ago. 1 million naira in dollar terms was a certain amount, right? If you sell the shares today and you're even lucky to sell for 1.5 million, that 1.5 million naira is less than the 1 million naira you invested 10 years ago. Even if you don't convert to dollars, just think about what can it buy, right? So on paper, you've made a gain of 500,000 naira, but in reality, you have lost money. And then on top of that, government is asking you to pay tax on the nominal gain, which is not real. So that makes it double punishment. So this is the analysis that support the fact that government needs to do indexation. Someone like me has pushed for this for the past 3 years at the policy level for government to enact it into law. And what they have said to me is we don't have a lot of data. Nigerians will take advantage of it, but we'll keep saying it. So that's the compelling reason why that needs to be done. And we have to also analyze this thing around not taxing seed, because if you tax seed, you compromise our ability to produce fruit tomorrow. If you allow us to grow, then we have plenty of fruit to tax and everybody will be happy. America receives more than $6 trillion, $6 trillion in taxes every single year. That's because they have plenty of fruits everywhere. That's why Elon Musk can pay $11 billion. Elon Musk wasn't paying that when he was investing in Tesla and the rest of it and hoping that they will break even. They allowed the guy to invest. They allowed the guy to grow. And once you grow, they show up and say, by the way, whereas in fact, by the way, in countries like America, you make losses on your investment, you claim it. That's why Donald Trump didn't pay tax for 18 years, because he had made losses from investment. And based on the rules, he's allowed to claim they actually didn't do anything wrong, just that he's not proud to say that he has not been paying taxes. So if the guy were to be living in Nigeria, he would have made his losses. Government would say, we are sorry. When he makes 1 naira gain, government will say, by the way, you need to pay tax, ignoring the fact that you made 1 million losses. What that does is that from a business point of view, it increases your risk of even venturing into anything at all. Investment is taking risk. When you make that risk even higher than it needs to be because of taxes and fiscal policies, it doesn't help anyone.
All right, this is from Olufemi Oluwale. It says, for litigation proceed that is not non-quantifiable loss, what kind of tax would apply? Capital gain tax or company income tax for company or payee for individual?
Yeah, so for an individual, it will clearly be capital gains tax because that's not a regular income. So we say compensation for anything for loss, for example. And there's a threshold that was recently created of 10 million naira, even though that was specific to compensation for loss of employment. But I'm sure that principle can also be applied to other compensations. For a company, it would also be a function of what do they do, what's their primary activity. I would imagine that if you're a stockbroker, for example, and you get a compensation for something you would normally earn in the ordinary course of your business, then you have to pay company income tax on it. There's a principle we call badges of trade. So badges of trade was a case law principle established to determine whether you should pay capital gains tax on an income or company's income tax. And it's not like a straightforward yes and no. And that's why I said initially that will be a function of what do you do. We can look at your memo and article of association, your ordinary business and all of that. How you disclose things in your financial statement is also important. So for a company where the income will be an extraordinary income, then you pay capital gains tax on it. For a company where this will be your regular income, maybe just the amount is a little bit higher, you say it's exceptional, it will be company's income tax. So if anybody on this call is affected by that, I'll really advise you to seek professional advice from your tax advisors as to how to proceed with it.
All right. Thank you again. This is from Samuel Sonowo. He says, I need a clarification on FIRS circular released on public notice on payment of income tax on profit from bonds and short-term government securities. The circular states that income tax applies on income derived by companies on bond and short-term securities, except for bonds issued by federal government. The same circular states that income tax is due on bonds and short-term securities issued by federal and state government.
Yes, the FRS was focusing on companies because they are not the ones to collect income taxes for individuals. So that circular was pretty much just focusing on companies. So as a company, if you invest in bonds, the interest that you earn is an income item, not a capital item. The proceeds of what you bought and sold can be capital if it's not your regular activity. Sometimes you have a bond where you may have bought at the secondary market at a discount. Like now the interest rates are higher, the value of those bonds are lower, which means if you then wait until maturity, you may get a higher amount that you invested. So you may also have a combination of when you are earning your returns, it could be a combination of both capital returns and income return. But the FRSC circular focus on the income return component, which is just the interest. What they're saying is just emphasizing the fact that the exemption order we had before in 2012 had expired, and therefore they're expecting everyone, should you earn interest on your bonds, you should come and file returns and pay company income tax, that's 30%. You pay education tax, which is 2.5%. When you give the balance to your shareholders, you pay withholding tax of 10%. Now, if the bond on which you are earning the interest is federal government bond, what they're saying is, don't worry, the exemption continues, even though under a different legal framework. So that's what the FRS is saying. Again, I'll say, take FRS circular, understand it, but bear in mind it's their own view. If you get legal and professional advice that says that's not correct, you can engage them directly and seek for a ruling, or you can seek judicial interpretation from the Tax Appeal Tribunal. And we encourage more people to do this because that's healthy for the system, so everybody does the right thing.
Okay, thank you so much. So this is a very last question. It says, what are the changes that should be expected in the 2022 Finance Act? Would there be a yearly review going forward?
Yeah, interesting. So some of it we discussed yesterday. I'll tell you the ones I can, which is really that government is looking at things to do with the climate, or should I call it the environment, essentially because of the commitment that Nigeria has made. So we're now looking at, even though we just started the meetings, I have to always put that caveat, nothing is cast in stone, but government is looking in the direction of what tax reforms and fiscal policy should we introduce to help Nigeria move towards a cleaner energy situation and also to meet our commitment about net zero, I think by year 2060. So that's one thing on the agenda. The another one that is there is what can we do to create employment, given that we're facing these challenges? What can we do to stabilize the value of the Naira? And one of the things I'd recommended already is that why is it that in Nigeria, we ask companies to pay taxes in foreign currency if the transaction was in foreign currency? So just imagine that I'm paying $1,000 today for a software that I need to do my business. I wish I can find that software in Nigeria, but I can't find it. I'll go to the foreign exchange market to go and bid for $1,000 just to pay the person. When I finish paying them, I'll go back to that market and bid another $150 to pay government. Now, when I go to the market to bid for that $150, I'm bidding for dollar that's already in Nigeria. It's not fresh dollar coming in. When I find that dollar, I give it back to government. You've added zero value to liquidity in Nigeria, but you've created a bigger problem by increasing artificial demand for dollar in the market, which has an impact on the value of Naira. So, and I say, why would a country not love its own currency? When all the whole world was sanctioning Russia, they did one thing. They said, buy my crude in my currency, and their currency has now even appreciated than before those sanctions. So I'm proposing now that in this finance bill, 2022, we should repeal that provision in all our laws. Let all taxes be paid in Naira, in Nigerian Naira, whether or not the transaction happened in foreign currency. So some other things we're looking at is also how can you encourage and help Nigerians find employment without having to leave Nigeria within the global value chain. PwC just published a report that we call Brain Capital. Our analysis shows that we can create up to 2 million jobs of Nigerians who are sitting in Nigeria and any foreign currency that will be more than we're getting from selling crude oil. So, but we have tax impediment that if you do that today, that company you're working for in the US, in Europe, will get into trouble in Nigeria. So why can't we just deal with that ourselves, remove that impediment, allow Nigerians to work for global organizations while sitting here, they earn FX, they pay personal income tax, they consume and pay VAT, government benefits, the employer in Europe or US does not get into trouble, everyone is happy. So these are some of the things we're looking to do in the next finance bill, and it will be good for other stakeholders to also put their input forward.
All right, thank you so much, Mr. Oyedele. I have learned so much from you today at the NGX Finance Act webinar. It was such a delight having you join us today. And to our participants as well, we're very honored and grateful to have you join us and for the questions that you have sent. We are very excited at what the new year will bring for us. At this point, I would like to call on the Head Product Development, Chidema Weke Okolo, to bring the session to a close.
All right, thank you, Mr. Oyedele. Distinguished ladies and gentlemen, thank you for your participation in this laudable event. We are delighted at the presentation and contribution from all the participants during this webinar. Certainly, the learnings from today's presentation have provided insights on the importance and applicability of the Finance Act 2021, and as well as how it guides operators in the capital markets. The exchange is very positive that this webinar would serve as a catalyst to improve understanding of provisions in the Act for both institutional and retail investors. Given the recent amendments and associated ambiguities of the provisions in the capital market, we have provided detailed information of key provisions and analyze the changes introduced by the Act. We hope that you found this presentation useful. However, you are free to engage us to provide detailed advice on the implications of the Act to your specific businesses. I would like to reiterate that the exchange is very big on investors' education and capacity building of market participants, and the NGX will continue to leverage relationships and partnerships to organize various workshops and webinars and conferences to support market education and awareness. Lastly, on behalf of the Board of Directors, management of staff of Nigerian Exchange Limited, I would like to thank our partners, Ashon and the CIS, and the participants on this call, but especially the presenter, Mr. Taiwo Oyelele for giving this presentation. I would like to use the opportunity and not put him on the spot, but would like to invite him back in January to give us another presentation on the new 2022 Act when it comes out. And I hope that he'll be able to accept his invitation now on our behalf. Thank you once again. It was a great presentation. Thank you once again for agreeing to participate, and we look forward to hearing from you in January. Thank you very much.
Thank you for having me. Bye.
Bye, everyone. Thank you. See you next year.